For New York City, for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, global bond yields surging to fresh milestones as hawkish Fed speak fuels more rate hiking bets, and bond vigilantes continue pressuring politicians. We begin with the big issue. Treasury yields keep spiking.
The story of this year has clearly been higher bond yields.
The rising bond yields.
We're back to a different era, and I think that we will stay here.
It really comes down to inflation.
We keep going back to inflation data.
We're probably going to see persistent inflation.
And that keeps yields still a bit on the upside.
U.S. data is not going to provide much leeway for yields to fall.
The underpinnings of the economy here in the U.S. is really quite robust.
The reality is that hard activity data are still pretty strong.
What that means to me ultimately is that the Fed has to do more to slow down the demand side.
The two-year yield always peaks above whatever the terminal rate is.
We still got about 75 basis points more to discount.
For a bond investor, it's all going to be about rates.
It is all about rates in pretty much every market. Joining us now, Morgan Stanley's Tirupattur, Invesco's Rob Waldner, and Meghan Graper of Barclays. Normally, we would start this with some sort of specific question to really sort of hone the moment. But I think that the only point that we can look at is real yield is actually something real now. How much further can it go? We have seen a retrace, but we'll get into the mess of today. Vishy, I want to start with you. What is the limit for real yield on 10-year treasuries as calculated by the markets?
We thought at the end of last week, with the terminal rate being priced close to 5%, we thought we are, at or near-term pause. Clearly, we were wrong, and rates have continued to go higher. But if I just step back and think about it, I think that the current levels are meaningfully above what the Fed thinks of as the long-term neutral rate. So I continue to think that that we are not far from having peaked in the 10-year yields, and at these levels. And I may be wrong on a near-term basis, but I think somewhere on a day-to-day basis, we might see still things get wider, yields going higher. But I think the fact that we are meaningfully above the long-term neutral expectations gives me some confidence that we would stabilize somewhere in the ballpark of where we are.
Meghan, do you agree?
Look, I mean, I think data is continuing to paint central banks and the Fed in particular into a bit of a corner, and neither the labor market nor the inflation backdrop in the U.S. is ultimately where it needs to be for the Fed to consider stepping down from what we think are sequential 75 basis point hikes in both November and December. And I think the market is starting to tell you that with some of the moves we've seen in rates. So beyond year end at Barclays, we're now of a view that we're likely to see an incremental and final 50 basis point hike in February before reversing course into the tail end of next year. So I think we're going to see the target range lifted to 5 to 5.25 in Q1.
Is that a new projection, by the way, Meghan?
It is. It was updated post CPI.
All right, and this is something that seems to be gaining traction as 5% Fed funds rate is being priced into the market for the first half of next year. Rob, what's your view in terms of where this shakes out for the 10-year, just in response to the comments that we've been hearing?
Yeah, hey, Lisa, we think in medium term, this is a good, the real yields around here, 1.8% is pretty attractive for a medium term. But what really worries me is short term. I think both other guests have talked about this. We seem to be getting a little bit disanchored. We don't have any forward guidance from the Fed. We don't know which way they're going. And if you look at the price action that we've had in the last week, the 30-year bond is up 30 basis points. And I'm not really sure what the news is that got us there. It seems like we're having auctions that are not doing very well. We're really getting the longer end of the market unanchored. And we've seen, like in the UK, what can happen if you get the longer end of the market unanchored. It can really build up momentum on its own. So I think we're a little bit worried about that.
Well, and I think that a lot of people are. Bank of America's Mark Cabana has been warning of Treasury market dysfunction, writing, quote, U.S. Treasury liquidity has deteriorated amid weak demand and investor risk aversion. The market is fragile and vulnerable to a shock. Rob, exactly to your point. A Treasury breakdown is not our base case, but it is a building tail risk. And I do wonder, though, how how much this is almost a ballast to markets. And hear me out here. I know this is sort of a strange counterintuitive thing, but, Vishy, what we saw today was that bond yields surged to the highest levels in the U.S. going back to 2007. The dollar was strengthening. The yen was weakening to levels we haven't seen since 1990. And then all of a sudden, don't call it yet intervention, but all of a sudden it started to strengthen a whole bunch. And, people are wondering, but it looks pretty much like it rhymes with intervention. How much do you have to see capitulation from global policymakers in a way that really kind of caps how far things can go? Vishy.
I think the capitulation you're beginning to see is actually from the bond investor perspective. I mean, I think there is if you look at the performance year to date, given how double-digit negative returns across the board, it's just simply a lack of risk appetite to engage in the markets that shows up in the transactional illiquidity in the market. And in fact, by some measures, by one of our measures of illiquidity, the treasury market is more illiquid today than it was during the peak of COVID crisis. And unlike the COVID crisis, where there was the whole cavalry of Fed apparatus to come through in the form of QE, that is not the case today. So we think that the challenge is really from a liquidity perspective. Undoubtedly, there's a very substantial challenge that is building, and it is, I think, as a consequence of many different things. Perhaps most notably is while there has been a policy tightening through monetary policy, there's also been policy tightening through regulatory policy. So the pressure on the risk-weighted assets on bank balance sheets is substantial, and we think that is contributing to this inability of broker-dealers to disintermediate these substantial market dislocations we are seeing.
But that really raises a question, Rob, of at what point do policymakers step in and try to stem off some of these potential fissures or illiquidities? And what we're seeing, at least when it comes to Japan, is they're going to intervene, but the Fed has still remained pretty hard at work to raise rates.
Yeah, you're exactly right. But I think that the policymakers in the U.S., the Fed could do something other than just intervene. The Fed could get out there and try and give us some forward guidance, try and tell us what we might be able to expect over the next over the next couple of quarters. Because at this point, they've clearly been data dependent. And if we get a bad data point, we revise up our expectations for the Fed. They need to give us more than that. They need to give us more than just look at the latest CPI print. And I think that will go a long way to bringing down Treasury volatility, interest rate volatility. And I think that would be very helpful.
But isn't that pretty much, Rob, what we got today from Nick Timiraos over at the Wall Street Journal when he came out with his article basically saying they might consider decelerating the rate hikes in December? I mean, isn't that basically all of the speeches that we keep getting and then the tea leaves that they're putting out there?
Possibly, but I'd love to hear it from Chair Powell.
All right. And Meghan, this really raises a question about when illiquidity creates enough of a pressure for them to stop. You said that you're thinking and Barclays thinking is that they're going to start pivoting next year. Is it going to be because of market dysfunction, or is it going to be because of what we're seeing in terms of economic negativity?
I mean, from where I sit, I think we're hearing loud and clear from this latest bout of Fed speak that at least for now, they're going to elect to take a much more restrictive stance, even as their somewhat backward-looking reaction function amplifies the risk that they over-tighten. But, I think where they've left some degree of ambiguity and where there's confusion in the market this week is related to how they react to upside inflation surprises once we actually get to that more elevated levels. Meaning, if we get to 5%, do they continue to aggressively tighten, or do they begin to try to, sort of point to a lag in monetary policy? And I think our view is that the risks are skewed to the latter, and you're seeing that play out in sort of an upward creeping of inflation break-evens. We're seeing that in where the futures market hasn't been anticipating the sort of peak target rate. So I don't think we see that pivot until the tail end of 2023.
Meghan, I'd love you to comment on what Vishy was talking about, how some of the regulatory overhang and some of the withdrawal of liquidity has created fissures and the sort of removal of a certain disintermediation role of big banks. If that's the case, why haven't we seen it more substantially in certain aspects of the credit market?
I think for as many major disruptions as we've seen in the global economy, it's not surprising to me that the sort of street has been bracing for some breakdown, for cracks to begin to show. And, I think for the most part, results have been better than feared. But I think equally, it's, the market's trying to digest that we're seeing growing recognition, not just from CEOs on the heels of their earnings releases, but also an acknowledgement that we're starting to see credit metrics largely peak. We're seeing margins that are beginning to come under pressure. Corporate cash balances have fallen over the course of the year. I think the next shoe to drop is sort of increased interest expense, which over time is likely to weigh on corporate profitability. So we're starting from a relatively strong position. I think it's hard to envision a scenario where we don't start shifting the lens to corporate fundamentals and they become center stage.
All right, we'll talk more about that coming up. Vishwanath, Tirupattur, Rob Waldner, and Meghan Graper, you're all sticking with us. We will be talking up next about the auction block. High-grade bond sales gaining momentum following weeks of lackluster volume. That conversation coming up next. This is Bloomberg Real Yield. I'm Lisa Abramowicz in for Jonathan Ferro. Time now for the auction block, where we kick things off in Europe. A steady deal flow coming into the market. Weekly sales totaling 29 billion euros after the first sterling corporate bond offering since early September. Over in the U.S., high-grade borrowers recording a rare streak of 5 straight days with new deals. Weekly volume nearing $20 billion, but still missing dealer estimates. And the junk bond market remaining practically frozen after the lowest Q3 volume in over a decade, on pace for the slowest October since 2008, despite this week's deal from Carnival, and that deal held a pretty hefty coupon. Sticking with credit, PGIM's Greg Peters saying spreads are still too tight. Take a listen.
Yields are up. That's great news, absolutely. But you haven't seen a repricing in the cyclical part of the market, the default risk part of the market. And so I think spreads are still too tight. The data has to soften. You have to start to see earnings roll over, margins compress. And so it has to become a fundamental story. So as of right now, it's just been a central bank repricing story, not a fundamental story.
Still with us, I am very happy to say Vishwanath Tirupattur, Rob Waldner, and Meghan Graper. Rob, I want to start with you. This question of where we are in terms of the credit cycle, pretty much everyone says that they like investment-grade credit. A lot of dispersion on high yield. In fact, more people dislike it. Rob, where do you fall on that particular area?
Well, Lisa, you summed up our view, I think, pretty well, which is the benefit to investment-grade credit is there's little in the way of near-term default risk. And, we think, back to where we started the show, that duration starts to be your friend here with yields where they are. So, we do like investment grade. I mean, I think the question here is why aren't spreads wider? And you played that clip from Greg. I think that the nominal GDP growing as fast as it has been a real tailwind for credit here that you don't normally have at this point in the cycle, which has had very high nominal GDP numbers. The question is what happens if nominal GDP slows while rates go up?
And that's the issue that I guess certain people have been gaming out, including you, Vishy, correct?
Yes. I think that I totally agree with Greg that not only because Greg used to be my boss several years ago, but Greg, I think the point that Greg makes is very valid. The higher the markets have really priced in the bond market, the credit markets have largely priced in the rate movements. And perhaps, even if there is a incrementally more higher rates to come, the delta, the change in that needs to be priced in is not a whole lot. But relative to expectations of a significant economic slowdown, whether or not there is an actual recession, that aspect is only now beginning to get priced, not fully priced in. In that sense, I agree with Greg's thesis.
And Meghan, this is the person who actually is seeing it on the ground. You, as the head of the syndicate over there at Barclays, investment-grade companies can still borrow. They might not love the rates that they're borrowing at, but they can still borrow. And yet, high-yield companies are having a much harder time. Why do you think we haven't seen more of a pricing in of that reality yet?
Yeah, it's a couple of factors that you're right. I mean, credit, both IG spreads and high yield spreads have been surprisingly well behaved in the face of some of these macro headwinds. But, I think that performance is not just a reflection of positioning, so how much cash remains in the system, but it's also a response to these underlying yields, which have been relentlessly higher. And I think contributing and helping to anchor both spreads and demand. So you're currently seeing 6% yield on the US corporate index. I mean, you'd have to go back to June of 2009 to reach that type of equivalent yield. If you bought in August, you were getting 4.5% coupons. If you're buying the calendar in October, an investor is getting closer to 6 and 6.20. So, there's a compelling case that there's value to be had for investors in the new issue market. For borrowers, it's the other side of the coin. The highest yields in over a decade means, there's a higher relative cost of funding. So that paired with fewer data-free windows as we become increasingly data dependent is ultimately translating to a primary market that remains undersupplied versus expectations. So much so that August record issuance that we saw has been followed by 2 consecutive months where we've disappointed to the downside, 9 consecutive weeks where we've undersupplied supply expectations. And so it's a bit of a grabbier market when you look at new issues. New issue oversubscriptions are close to 4 times oversubscribed in October, despite the fact that we're running at about half the volumes that the market had anticipated kicking off the month. So the technicals are in the favor of sort of insulatory moves in IG. I think all that said, as we move to more vulnerable parts of the economy, if we start to move into a recessionary type backdrop, we're going to see decompression between IG and high yield spreads. We're going to see a greater degree of dispersion as fundamentals become more front and center. And ultimately, I think credit selection is going to be the name of the game as we move into 2023.
Meghan, do you think that the message right now from high yield and from investment grade is coherent, based on the fact that spreads have been widening for both and rates have been rising for both? That's the reason why investment grade has underperformed to such a degree, even though everyone's talking about recession.
Yeah, on the high yield side of things, they're obviously less rate sensitive, but we've also seen an index that is shrinking. It's visibly smaller than it was this time last year. You've seen the market value drop close to 26%. If you think about why that is, we've seen a lack of new issuance in high yield. You've seen an uptick in rising stars. There's record rising star activity, about 100 billion moving into investment grade. Yeah. So we're not seeing sellers into that shrinking universe. But there's also a lag. I think as the cracks begin to emerge, we're probably 35 to 40 basis points wider to go in investment grade spreads. I think it's probably closer to 300 basis points of widening in high yield over the next few months. So there's a lot of moving pieces, but I think the supply demand imbalance is keeping us insulated for now. That's likely to erode as we move into 2023.
Which is really the issue. And Rob and Vishy, just if we could quickly get you guys to comment. Rob, how much do you see the likelihood of some forced selling of leverage that we don't yet see that's going to be unwound?
Well, Lisa, we spent quite a lot of time trying to figure out where that leverage is that would get forced, right? Because the difference between leverage, like you have built into the, let's say, CLO structures or other structures like that, and leverage that would get forced unwind. And we just don't see where that is. So I don't have an answer for that.
What about you, Vishy? Do you have a sense?
I agree that the kind of leverage unwind that we saw out of the UK liability-driven investors, that those type of strategies, we don't see that materializing. But one potential thing that we are beginning to think a lot about is if the Japanese buyers have been big buyers of U.S. credit. And with the dollar yen weakening to the 150 plus range, is there a possibility that they will either be less of a buyers because they hedged into the Japanese yen? The yields are not nearly as compelling as they used to be. But the saving grace here is that the hedging that the Japanese investors typically do is sort of 3-month rolling FX hedges and don't have the similar consequences as the long-term derivatives that were on the liability-driven UK pension funds, or et cetera. So I'm with Rob. We are also looking for what could be the potential place for these leverage unwind. One place we don't have a lot of information on, especially a lot of clarity, is perhaps in the private credit market. but we don't know a lot about. We don't know about the leverage in the system. We don't know about the metrics in the system. That is the one place that potentially could be the source. But I'm certainly not saying that is the source. But that's a place we know very little about.
Vishy Tirupattur, Rob Waldner, Meghan Graper, you're all sticking with us, and we really appreciate that. Still ahead is the final spread, the week ahead, featuring a host of central bank rate decisions, starring the ECB and the Bank of England. That conversation coming up next. This is Bloomberg Real Yield. I'm Lisa Abramowicz in for Jonathan Ferro. Time now for the final spread. The week ahead, coming up, PMIs from U.S., U.K., and Eurozone all out on Monday. Then consumer confidence on Tuesday, new home sales Wednesday, plus U.S. GDP coming on Thursday. And finally, a host of rate decisions, including the ECB and then the BOJ to close out the week on Friday. Still with us, so happy to say, Vishy Tirupattur, Rob Waldner, and Meghan Graper. I want to go straight to the rapid fire. I did want to ask a little bit more open-ended questions, but they are really quick answers, please. So the first one is, where are Fed funds rates at the end of 2024? Meghan?
Close to 5%.
Rob?
3.
All right. Vishy?
450.
Interesting. When does QT in the United States stop? Vishy?
I think third, fourth quarter of next year.
Rob?
End of 2024.
Meghan?
End of the first half.
Interesting. When does the first Fed rate cuts come? Rob?
Third quarter 23.
All right. Meghan?
Last 3 meetings of next year.
Vishy?
End of 2023.
Well, my thank you to all of you, Vishy Tirupattur, Rob Waldner, and Meghan Graper. This is a tremendous moment because we are looking at yield that finally is real in some capacity or another, that all of a sudden treasuries are an alternative. And yet, as we just heard, there is a real unmooring right now of some of the yield moves from a sense of what is driving them. Is it simply a lack of buyers? And that has been one of the main questions as we head into next year. How do central bankers respond to this at a time where inflation is a place that we have not seen for a very long time? From New York, that does it from us. Jonathan Ferro returns, same time, same place next week. This was Bloomberg Real Yield. And yes, it is finally actual real yield. This is Bloomberg.